It does. It certainly reaffirms the point that we do talk about a lot when it comes to sort of overall investing, is that the short term gain doesn't necessarily always reflect what the long term outcome is, likely to be. And so, yeah, well, you might see the volatility and the prices spike for a whole bunch of assets short term, something like that. You can't help but think that trend is towards those lower costs, lower prices. Welcome to the Exponential Investor Podcast. Want to be a better, smarter, more clued up investor? Well, you've come to the right place. We cover the breakthrough investment ideas you don't hear about in the mainstream to keep you on top of the megatrends and opportunities reshaping our world. Good morning. Welcome to another Exponential Investor Podcast. I am your editor, Sam Volkering, and I'm here with my co-editor, again, as usual, Kit Winder. Thanks for joining us, Kit. I wanted to kick this off today with a question, actually, and I'll give it some context. I start every one of these with a question usually, but let me start it with another question. So this week, the billionaire CEO of JPMorgan, Jamie Dimon, had some critical things to say about Bitcoin. More specifically, he was talking at some banking event and questioned the ability for Bitcoin to actually only ever have 21 million Bitcoin exist. And he asked the question, how do we know that that's actually going to happen? Do you read the algorithms? And basically said that he and a lot of people at JP Morgan are skeptical of these sorts of things. Now, I find what he said astonishingly ignorant, because yes, we do read the algorithms when it comes to Bitcoin because we can read the code because it's open source. But that's my question isn't necessarily related to that. Now, you're obviously heavily involved in energy markets, the technology and the breakthroughs that are coming in that space. My question is this: how much weight do we give to people like Dimon and others that sit in these ivory towers from a system that has served them very well, that they are clearly interested in protecting for their own self-interests? Why does everyone seem to give weight to these people when it comes to breakthrough and new ideas and technologies like cryptocurrency and Bitcoin and like green energy markets? I imagine there are a plethora of similar instances from people from big oil that have said similar things about the energy transition. How much should investors actually care about what these kinds of people have to say?
Yeah, I mean, it's a very good point. I'd say in the energy markets, it's more clear the sort of difference between the incumbency and the groupthink. And so I just read Jeremy Leggett's book, Winning the Carbon War, which is a sort of 2-year diary running up to Paris 2015. And it's brilliant, actually. It's a sort of first-person account, and he's so high level that he's meeting all of the most relevant senior people who are involved in governments and corporates. And one of the things he talks about a lot is the sort of behavioral communal thinking within social groups, and how this sort of leads people within oil companies, as he says it, they love their families and their children, and they're good people, they recycle, and they kind of know that the energy transition is happening, but then they go to work and keep doing what they're doing, and there's this dissonance there. And within the oil industry, it just sort of creates its own belief system that is actually incredibly hard to break. And so that is now just very clear. I mean, anyone who is aggressively defending fossil fuel growth for the next decade or two is either being paid or they've misunderstood, or whatever. So you can sort of almost pick out I'm quite cynical now about fossil fuel defenders, really, about, when the Texas energy crisis happened, you looked at all of the things that sort of oil lobbied Republican politicians were tweeting and saying, and it was just, they just get $800,000 a year from fossil fuel lobby groups, and that's all it is,
Yeah, I suspect that like you say, there's lobby groups and paid people that are there to defend. The point you raised before is actually something that I came across recently as well, is where you say people that might work for some of these companies, like you say, they go home, they recycle, they maybe have an electric car. They're doing the way they behave as to where they generate their income from are sometimes divergent. With which is something that everybody I guess has to live with at some point. When sometimes you have these internal conflicts, it's a very similar thing I heard last week. So last Thursday and Friday, I was at a conference in London, the Token 2049 conference, and it was all about cryptocurrencies, the crypto economy, everything from like regulation to gaming, blockchains, privacy, exchanges, decentralization of everything, you name it. And one of the things that I found interesting was that they were talking a lot about the institutionalization of cryptocurrency, and that you get these big organizations that are still quite reluctant to even just look at, let alone hold something like Bitcoin. And what they were saying was that now we're starting to just see things like pension funds start to sort of dip their toe into the game. But the interesting thing is that a lot of the people that work for these sorts of funds in their own personal existence are already well into this. They're already holding Bitcoin, and they're already diving deeper into the broader crypto ecosystem. But when you look at these giant organizations and the structures that they exist under, it's not always such a simple thing to sort of adjust the course of the ship. And I very much expect that what you probably see something similar is that when you are dealing in energy markets and you look at the big players like Shell and BP, and we know they sort of have a very large foot in the existing camp, but they also do have a foot in the transition itself as well. Do you see those big companies? Do you see them righting the ship? Do you think that, like for instance, do you see a company like BP in the future not having any oil and gas assets at all?
I think it is possible. I think the economics are so clear now for the fossil fuel industry that demand is going to fall off over the next 30 years. It has to. It's going to be socially demanded and politically mandated, and economically viable to move to cheaper alternatives. So when our vehicles are powered by electricity from renewables will massively undercut the sort of gas and coal-fired alternatives. And then that's how electricity starts competing with oil, on the roads, for example. And so if you look at BP's balance sheet, they say they have, X amount of reserves of oil and they're going to sell it for this much, they predict. And so they value their company at Y. But in reality, Carbon Tracker is really the company that pioneered the concept of stranded assets, which is that almost all of these fossil fuel companies think that they have X amount of value locked up underground, but they won't be able to sell it. And maybe they'll be 20% or 40% stranded assets, which makes them so much less valuable. And as all oil demand falls, who's going to be able to sell oil is probably the question. Who's going to be able to ride out the fall in demand? And it's pretty simply the lowest cost producer, which is, to be honest, Saudi Arabia. They can pull oil out of the ground for less than $10 a barrel. So if oil prices will trend towards that figure. And once demand has peaked, volatility increases. So what we're seeing at the moment is oil price volatility. It's like a fish that's come out of the water. It's dying, but it's started flapping. And, volatility increases as death arrives. For these things, we saw it with coal, even more dramatically. Global coal demand peaked in 2013, and now it's spiking, and everyone's like, oh, maybe this is a whole new thing for coal. It's not. It's just, when your asset hasn't been growing in 8 years, you don't invest properly in supply chains and distribution chains, and demand and supply get mismatched more easily. We'll start seeing similar things with oil, I think. So I think on this podcast one time before, I said we could see $300 oil, but the grand trend over the next 30 years is towards probably between $10 and $20, because A, that's the only way it can be in any way competitive with renewables, and B, it'll be the lowest cost producers who are selling and undercutting everyone else when I mean, the IEA predicted demand will fall from 96 million barrels per day last year to 25 or 24, I think they said. So a quarter of what it is today. And yeah, the cheapest producer will do the selling.
It does. It certainly reaffirms the point that we do talk about a lot when it comes to sort of overall investing, is that the short-term game doesn't necessarily always reflect what the long-term outcome is, likely to be. And so, yeah, well, you might see the volatility and the prices spike for a whole bunch of assets short term, something like that. You can't help but think that trend is towards those lower costs, lower prices, which is it's fascinating. And I mean, if we want to talk about volatility, then obviously the crypto markets are something that I've been looking at closely for some time, and that certainly has its moments of ups and downs, and it's almost like the inverse of oil is that some of the short-term fluctuations down don't necessarily reflect that the long-term view that when you factor in demand and supply, demand increasing, supply constraints, which if Mr. Dimon bothered to actually...
What supply constraints, Sam? How do you know?
If Mr. Dimon bothered to read the algorithms, as we all do, you would know that there are defined supply constraints.
I have to say, I sympathise with him only on one point, that it's not bothering to read the algorithms. It's a capability issue, not an effort issue. He's not lazily thinking, oh, maybe I should get around to the algorithms. Like me, he's thinking, what am I looking at here? But I think your point earlier was interesting. I mean, Bill, if you ever see a headline that says Bill Gates backed clean energy venture, you'll probably see that ESS, a battery company, launched this week, and I think it went up 125% on its second day of trading or something crazy. It just spiked. And he is a classic example of a name that carries undue weight. I mean, within the energy transition sort of space, I've done 3 series of the Beyond Oil interviews. I've met incredible, unbelievably brilliant people who have such a brilliant understanding of how these things are playing out. And I don't think he matches up against those people in this space. He clearly is so brilliant, and I think it's just that slight Nassim Taleb point of expertise in one field does not guarantee it in another. And he has good ideas, but he talks about a thing called the green premium, where it's going to be so expensive to do a transition, so how can we narrow that green premium to make it as cheap as possible? But I think the more interesting ideas are how disruptions in energy, food and transport are all going to compound one another to make actually the transition just cheaper than what came before, that the new system is going to save us money rather than costing us money. And I think he's actually sort of behind on that, and he's not always backing the companies that we think are the best companies. So he's good, but he's not the best, but his name gets put on things and they go up.
And he brings a great amount of money through his venture investment vehicles as well. And so I think that's where people sometimes get confused, is that sometimes these decisions and the ultimate investment vehicle isn't necessarily those who you might think it is. And like you say, expertise in one area. I'm sure Mr. Dimon is an expertise in complex financial products that nobody understands or bothers to read the terms and conditions for. So, I'm sure he's an expert in his field.
Can anyone read the terms and conditions, Sam? Are they visible?
Do we read the terms and conditions? Maybe no, we don't. Which is why some of those complex financial products we maybe should avoid. But the thing is that something like Bitcoin is 100% transparent, and that's something that our readers may have seen a bit of this week, coming out of Exponential Investor and from myself. Some talk about an upgrade that's coming to Bitcoin's core network, which anybody can go and see. I might add, you can, if you're technically minded and want to look at the code, then feel free to do so. And you may see, or may have already seen, a webinar, a broadcast from myself and my colleague and friend Boaz Shoshan talking about this great upgrade to Bitcoin's network and what it's going to do, not just for Bitcoin, but for the wider crypto ecosystem. So I think that's something that if you haven't seen that yet, I'm sure we'll have a link somewhere on around near this video that you'll be able to click on as usual to check out that broadcast. The thing about it that is very exciting is that it's an absolute certainty. It's locked in. I think we're only about a month away from it activating, and it could unlock a tremendous amount of wealth in the crypto ecosystem. So make sure you check out that video where we discuss about Bitcoin's next great upgrade and the wealth that it could unlock for investors. But I think we've probably gone on for long enough this week, Kit. Like I say, great to get your insight as usual. I think a good takeaway here for investors is that when you see these big names, these billionaires, these titans of industry talking about things, you might want to check that they actually know what they're talking about before you place any great weight on their comments. And if you find that they don't know what they're talking about, which can sometimes be the case, take what they say with a very small pinch of salt, or a big pinch of salt. What is it? Is it a large pinch of salt? I don't know, whatever. Take it with a pinch of salt. Any closing remarks you'd like to drop in as we wind up this week, Kit?
Yeah, well, I think just, it was an interesting point you make about Dimon. I'd say, I think the reason it gets so much attention is probably not that everyone thinks that what he says is necessarily right, but what he says does matter. I mean, he's one of the most successful banking CEOs of the last decade. He has done a brilliant job with JPMorgan. So he is so powerful that his views might affect the market in future. So it still pays to think about what he's saying, because it might affect how JPMorgan goes about the crypto or whatever, but it doesn't mean he's right, as you say. And yeah, on the webinar that you mentioned there, as regular listeners will know, I'm not the crypto expert of the two of us, but I am interested and I am an investor, and I have watched it and I have read up around the upgrades that you're talking about and the things that they're going to do, and I can genuinely say quite honestly that it's about as excited as I've been about crypto in over a year or two, or maybe even in my whole short interest span or life. It really is. Yeah, it's fascinating. It's exciting. And I do encourage people to go and watch it, because, then you won't make silly mistakes like Jamie.
Exactly. Then you'll know more than Mr. Dimon, and probably, a lot of statistics are made up, and I'm going to make one up here, but you'll probably know more than 90% of the traditional financial industry around cryptocurrency as well. So it pays to know what is happening. It pays to know what it means. And it can certainly put you ahead of the average banker, so to speak. So thanks again, Kit, for joining me. Thanks again, everyone, for watching, for listening, however you are consuming this media, through your ears or eyes, and or both. We'll be back with you again next week for another Exponential Investor podcast. Bye for now.